Welcome back, everyone in YouTube land. This is your tinfoil hat economist coming back to you at the speed of light with episode number 11, Investing in the Age of a Global Malady. Well, as I predicted last week on Wall Street, ending March 20, was a terrible week. We are in the throes of this global pandemic, and we are not seeing the kinds of response we need to see from the federal government and our central bank, the Federal Reserve, to at least put a bulwark up against what we see ahead. Congress is anticipating, quibbling, debating, futzing around with a stimulus package of $1 to $1.5 trillion. If ever there was a time, my friends, if ever there was a time for the federal government to go big, it is now. $2 or $3 trillion I would prefer in the form of tax cuts, a payroll tax holiday to the end of the year, a radical reduction in income withholding rates and tables on income, mostly wages and salaries, is certainly should be front and burner. Now, over to the Federal Reserve. They've been engaged in bringing interest rates down to zero and a large quantitative easing package and some sort of liquidity programs, repo stuff, and dollar swaps and who knows what. But they're not doing what they have to do, which is helicopter drops, not on Wall Street, not on international capital markets. Those are worthy. What they should be doing is helicopter drops on Main Street. The central bank just has to print up money, send it over to the Treasury to make up for lost tax receipts through the tax cuts I recommended. This is something Stanley Fischer, the former vice chairman of the Federal Reserve, former governor of the Bank of Israel, former professor at MIT, former professor at University of Chicago, students like Ben Bernanke, Mario Draghi, is proposing helicopter drops. So now is the time. So what does this mean? I think, unfortunately, we've only seen the first leg or two of the bear, and the bear has 4 legs. As I showed to you last week, and I'll show to you again, this is the kind of corrections we see in major bear markets. 48%, that was the oil shock. 73, 74. 2000 to 2002 was the dot-com bust. 2007 to 2009 was the the global financial crisis, the Great Recession in the United States. And you see this number, 32%. That's the bear market so far in the U.S., and that is from the peak on February 19. February 19 was a month and 2 days ago, and it seems like 100 years ago, doesn't it? Oh, I'm not looking for strength. We might get a bounce next week. On week to week, it's very difficult to anticipate, of course, what Wall Street will do, but I am looking for more southerly movement in the markets in the months ahead. And one reason I say that is I haven't seen an exit strategy from these lockdowns, which are being spread across the United States and, of course, across the world. There doesn't seem to be a plan in place. At the end of a 2 or 3 week lockdown, we've got to get back to normal. I don't know what to make of people that opened up restaurants or in the events business, hotel owners, hotel chains, restaurant chains. There's a restaurant chain, Darden Restaurants, DRI. It's off 60, 70% now. Airlines. I don't think public policy makers understand the ramifications of this. These people are not going to be able to honor debt, pay their bills, and That could have grievous consequences for our financial system. Inherently, a fragile financial system tends to borrow short to lend long, and lend long at 700% of deposits. I just described a commercial bank. I'm going to say something controversial. I think we have to bite the bullet on this virus and go back to work. If you read your history, the 1957 to 58 Asian flu came through the United States. It did leave 116,000 dead, and no one stopped anything ever. There was baseball season, there was football season. Restaurants and bars did not close. Life went on. It sounds callous to say this, but the damage that's being done to the economy will far exceed the benefits of these lockdowns. So this is your tinfoil hat economist signing off at the speed of light. I look forward to seeing all of you again on episode number 12, when we will again look at the investment world in the age of this global malady.